I hate to say this, but as it seems like the world is preparing for what may become World War III, investors and German regulators, but also the businesses themselves, need to have a better understanding of how German firms are working in China and working with the Communist Party, both for purely economic reasons and business decisions, but also for questions of national security.
Many companies are under increasing pressure to limit their exposure to China. But how exactly are they exposed in the first place? My guest is Isaac Stonefish, the CEO and founder of Strategy Risks. That's a company that's come up with its own analysis of China exposure. Isaac, welcome to the show. We've seen in recent years sanctions, trade restrictions, supply chain legislation, and increased political pressure to limit firms' exposure to China. These are your potential customers. What do they want?
They want to understand how exactly they're exposed, what that means, and then what to do about it. And there's a lot of risk mitigation strategies that they can have, and other folks in the ecosystem, including investors and regulators, also want concrete information about companies' links to China and how that affects their share prices and their business operations.
When we say exposed, I would assume that there's several levels here. I can imagine, for example, we're talking about some companies, they make a lot of their revenues or their earnings in China. Maybe they're exposed in that way. And maybe others also have supply chains there. Can you sort of take us through these levels of exposure?
Yes, we define it in two different ways, explicit and implicit. We have one index, the SR250, that looks at the explicit risks of major US companies, and that looks at business fundamentals, partnerships and politics, which is links between the companies and the Communist Party, supply chain, regional issues, which looks at links between places that are very sensitive, like Xinjiang and Tibet, and then also opacity. How much are the companies talking about their links to China? For more implicit risks, we look at, for our multinational risk index, trade and economic risks, and that looks at different ways from a broader, including explicit and implicit with a focus on implicit, a broader set of risks of links to China, links to China's economy, and links to China's trade practices.
What is this in relation to? Is there some sort of score they receive, or are they compared to one another? How do you measure the level of risk?
Yes, we measure it out of 100, with a higher score being higher risk and a lower score being lower risk. There is no 0 and there is no 100. Business is risk. There's no way to act or invest regardless of the market that you're in. And our broad thesis here is that companies and investors have long mispriced China risk. And so this is a way to keep score on that.
I know that some of these companies are very big, of course. They have divisions all over the place. And there's a lot of maybe opaqueness in that. But to some extent, it seems strange that you're giving these companies something that I would think that they should be able to see themselves, right? Don't they have internal auditors or internal control mechanisms?
Sometimes with companies, because they are so close to it, it's too sensitive for them to come up with these scores. And the people who have really intimate understandings of their business in China aren't able to talk about this for various Chinese regulatory reasons. We also feel like it's very important for other people in the ecosystem, for the company's partners, for their competitors, for their investors, for their regulators, to have a really good understanding of this.
And in fact, you publish a lot of these rankings that you've already talked about. And I want to mention, before we talk about what's behind your analysis a little bit more, let's look at an example. You've recently ranked US companies with the most exposure to China. And Ford, for example, came in above Tesla, which I found interesting because I would think that Tesla is a company that it leads foreign automakers in exporting from China and, of course, relies heavily on domestic sales in China. Why was Ford, in that case, more exposed than Tesla to China?
It was also very surprising to me. And in my mind, it points to the integrity of the data, that sometimes it just comes up with results that we wouldn't fully expect. With Ford, it's because of the partnerships that Ford has long had with the Chinese Communist Party. That's what really pushed it over the top. And it's very important for companies to understand that being the most exposed to China doesn't mean that your business is the most successful in China. I think you're right. I think arguably Tesla and GM and other auto companies have been more successful in China than Ford has. It's just Ford has made a lot of strategic decisions to get itself more entangled with China and with the Chinese Communist Party.
Our viewers probably have some idea of this already, but what are the biggest risks that we hear from the business world when it comes to China right now? I would imagine geopolitical sanctions, for example, but also economic because the economy is down. Do you look at that as well?
We do, and we feel like the biggest risks for U.S. companies and frankly for Chinese companies too is what's coming out of Beijing. Chinese regulations, Chinese competition, the threatening of business people, both Chinese and otherwise, leaking or outright stealing of IP. So there's a lot of really domestic risks at this as well. And we have to remember that to a pretty broad degree, Xi Jinping does not want foreign businesses to thrive in China. When you step back and look at it globally, there's tariffs, there's China's slowing economy and what that does to the rest of the world, and then very real regulatory and PR risks because governments and consumers in Germany, in the UK, and especially in the United States, are looking more critically at businesses that are heavily exposed to China.
Well, Isaac, we're, of course, a German broadcaster here, and there's a big debate in Germany about exposure to China amongst German firms, both big and small. Let's take a look at a few ones. You've taken a look at Deutsche Bank and SAP in particular. Can you just tell us, what do you see when you look at these two firms?
For SAP, what we find to be fascinating there is the idea with implicit risks is not, here's the way that SAP is directly integrated into the China's economy or necessarily has a very large footprint there, but the way that China's economic might and globalization has linked businesses around the world, including SAP, to the rise and fall of China's economy. And so SAP is a little bit below average, but still has meaningful exposure, which means that as China's economy grows or shrinks and as its trade practices change and evolve, SAP has material links to China's economy. And for German firms in general, we do feel like there needs to be more spotlight shown on the exposure, and investors and German regulators, but also the businesses themselves, need to have a better understanding of how German firms are working in China and working with the Communist Party, both for purely economic reasons and business decisions, but also for questions of national security.
So if I understand this correctly, then we could say with Deutsche Bank and perhaps also with SAP that neither of these has maybe so much direct exposure to China in terms of their businesses, goods, whatever they're producing. In the case of Deutsche Bank, not really producing, but because perhaps they have financial ties to firms that are heavily dependent on China. In the case of Deutsche Bank, maybe they have a lot of loans out. In that case, a lot of credit lines. In the case of SAP, I would imagine largely service as a software, or software as a service rather. So I'd imagine they're also connected to a lot of businesses that in turn may then be reliant on China. Is that fair to say in general?
Exactly. And so if we had run the SR 250 type of method, the strategy risks 250, with Deutsche Bank, we would expect them to have, a considerably lower score than, say, JP Morgan or Goldman Sachs. But because of all of this secondary exposure, that's really getting picked up. And, in the case of German companies, we would expect Volkswagen to have a very high direct exposure score, but potentially a lower indirect exposure score because of the business lines that it's in.
And yet, of course, we talk so much about the Volkswagens, the BASFs, for example. Do you feel that we're not maybe talking about those secondary effects or tertiary effects through the German economy or, by comparison in the U.S. economy from some sort of risk in China?
Exactly. So picture a German energy company that really tries to keep its business hived off from China. It doesn't buy from China, it doesn't sell to China, but China is a big determiner of the price of various commodities. And if you're in that business, you can't be isolated from China. It's just not the way the global economy works. And so if you're an investor in said German energy company, you need to understand how China impacts that business.
So just to understand, a lot of these, for the MRI, I believe it's the MRI index in this case, these scores are being adjusted daily almost. So why would Deutsche Bank maybe one day be up and then maybe in 2 months it would be down again? Has a lot of curves, obviously a lot of movement in these charts. Is it because perhaps they reduced their risk to a certain company that has high risk to China? How do you take all this into effect?
Yeah, there's so many factors that play into the movement of scores, and various Chinese economic indicators and global indicators that move on a daily basis. And so all of these things come in and play in. And I should also say here, for a caveat, as with all of these products, there is no perfect reflection of what exposure to China is. And some of this has required analyst decision making on what are the right inputs for the score. But we feel like it does a really good job of, in a way, creating order out of chaos and saying, hey, this is a good way of understanding what Deutsche Bank's exposure is and how it changes depending on both decisions that Deutsche Bank may be making or broader Chinese or global economic factors and trade factors.
We touched on this a little bit, but where exactly is this pressure coming from? Is it from the business side, feeling that it needs to have this insight? Is it because of maybe investors want to have that kind of insight? You see them also as benefiting from this?
There's been a push over the last several decades for globalization, and now we're seeing the unraveling of a lot of the trade ties that has really been the main thrust of the global economy. And so we see this push as a reflection of this trend where economies are decoupling from each other. As I hate to say this, but as it seems like the world is preparing for what may become World War III, with the war in Russia and Ukraine expanding and increased tensions between the US and China and broadly the West and China. And so businesses, regulators, and investors really need to understand what this exposure is. I think it's also something with the former idea that a business just had one domicile. So the idea that a German company is just a German company as opposed to a company that is exposed to many different markets around the world. And China is the most important one for many German companies, but it's not the only one. There's data to be had and studies to be done about, say, German exposure to India or Saudi Arabia and what the impact that has on various parts of the business.
We know that here in Germany, there's a lot of talk about some of these larger companies like Volkswagen, BASF, leaving a lot of their investment in country and building out the corporations there or the divisions there as almost sort of standalone companies within that country. Do you see this happening a bit more, this kind of ring fencing as these risks grow? Are we also seeing that with American businesses, for example?
We do. We saw it first with Yum Brands, which we saw that first with Yum Brands, which roughly a decade ago split off its China business, which now seems like a very prescient strategy. And we're seeing push for HSBC to potentially break up into two different companies, one that focuses on its global and Western business and one that focuses on its China business. We see that with some German companies as well. Basically, the idea of we have to have a China for China strategy. We're not going to be able to bring money out of China because of increasing capital controls, and a lot of Chinese regulations either contradict various European laws or cause controversy in European and American capitals. The encouragement, for example, for businesses to operate in Xinjiang or to source from Xinjiang. Xinjiang is a region in northwest China where the party has been committing a genocide against the local Uyghur population. Very controversial move for businesses to operate there, but there's a lot of pressure inside China for global businesses to be in Xinjiang. And so if companies break up into various component parts or have that sort of ring fencing, it does reduce the PR and regulatory cost of them in Germany and around the world.
All right, Isaac Stonefish, founder and CEO of Strategy Risks, which assesses companies' exposure to China. We'll have to leave it there for now. A fascinating topic, though. Isaac, thank you so much.
Thank you. I appreciate it.